watching ABC4 News, celebrating 75 years.
Welcome back. The American financial system is still taking stock this week after the sudden collapse of Silicon Valley Bank in California and Signature Bank in New York. The SVB collapse represents the biggest bank failure since the 2008 financial crisis, and it has investors, startups, and families anxiously waiting for this shoe to drop. So here to help make sense of all of this, we have Jeremy Blair. He is the Vice President for Finance for Mountain America Credit Union. Jeremy, thank you so much for joining us.
You bet.
So I can imagine a lot of your customers have been panicking, whether or not they were a customer of SVB Bank, just the concern overall on what this could mean. What are you hearing from people?
You know, everybody sees this and they look back, they immediately hear echoes of 2008. It was 15 years ago, almost to the day, that we saw Bear Stearns fail, starting a huge financial collapse throughout the banking industry back then. This is very different, and that's the first thing that we want to point out to people. That was a credit crisis. There was loans that were failing. This is very different because it's focused on some concentration issues with a bank and a couple of banks that were very focused on a very specific sector of the economy. And when that sector failed, it took great pains on those banks and took them down with it. We'll talk a lot about diversity when we talk with our members, about the importance of making sure your financial institution has a diverse base. I can only use us as an example because it's what I know. We are in the communities that we serve, bankers and teachers and miners and farmers and all walks of life. And that's really important when you're looking at your financial institutions. Make sure that they're not just concentrated in a single area. That diversity provides literal strength.
Mm-hmm. You mentioned kind of a failure that we saw with these banks. What happened?
Yeah. So what essentially went wrong was this bank had a very strong, very good, robust client base. And it's a very old bank that's been around for quite a while. It was doing really well. And throughout the financial difficulties that came about from COVID, they saw actually deposits grow exponentially. They doubled and almost tripled in size in a very short period of time. They took that money and they invested in very long-term investments, which is not necessarily a bad thing. They were safe investments, but then when interest rates started to rise quickly, those investments started to drop in value, and they couldn't get their money out of them without taking huge losses. So when their industry started to drop and their depositors started using their money and taking it out of their accounts, this bank was left with a shortfall of liquidity.
And I know we talked a little bit about, how in this case, all the customers seem to be safe since the federal government did step in. But if this were to happen again, maybe at a larger scale, I mean, what's to prevent that from happening?
Yeah, that's a great question. And I'd love to tell you that this won't happen again, but financial crises do happen, and they're the ones that we've never seen before. Fortunately, this isn't a repeat of something we've already seen, which means regulations will step in and hopefully make some improvements. But I think one of the biggest things we need to do is revisit how that insurance cap is instituted. The federal government did exactly what they're supposed to do in this scenario. It's to step in and not protect the businesses, but protect the people, right? The businesses that underlie these banks, the families and the entrepreneurs whose payrolls are paid out of these banks. They stepped in to say, you know what, we're gonna cover you so you don't have to worry about that, because that could have caused a real ripple effect through the economy. I think that's something that the federal government will have to look carefully at and see if that's something that they need to make changes to in the future.
I know a lot of people were talking about being FDIC insured, that cap at $250,000 for people who maybe have a little bit more money than that. I know some people talk about spreading it across several banks. What advice do you have?
Diversification is always a good thing. I never discourage anyone to not diversify, but I would say certainly go in and have a very frank conversation with your bank. Talk to them and say, tell me how you're different from SVB so I know that I'm confident that this bank or this credit union is safe. And hopefully they'll talk to you about how diverse their membership base is and how that helps create that security so you don't have to worry about a single industry failure or anything like that.
Are there any red flags that you should be watching for when you do have that discussion with a potential bank?
Definitely. If they can't answer your questions, that's a big red flag immediately, right? And you want to consider that. And that might be an opportunity to look at some other banks that are out there, some other credit unions that can provide similar services. Make sure that they do have the services that you need in particular. For your everyday investor, most of us don't have more than the insured cap. But if you're a small business owner or a business that has a payroll that might be higher than $250,000, you've got to put some big concentration in any one institution. Talk to a financial planner. Sometimes they can help guide you. The public records for these banks are all on the FDIC's website. You can go check there, or NCUA for a credit union, and just look at their balance sheet. Make sure that there's nothing in there that scares you, or anything that does, you want to ask them about it.
All right, Jeremy Blair, thank you so much for providing this information. I'm sure it started a lot of conversations for people and having a lot of people reevaluate their finances.
Thanks.
All right, let's toss it over to Alana.